What if you could spot a market crash before it happens and protect your money while everyone else is panicking? When the market breaks, the signs are always there. The key is knowing what to watch for. Market crashes don't happen randomly. They leave clues: rising volatility, institutional selling, liquidity shifts, and changes in investor behavior. Understanding these warning signals can help you protect your investments, reduce losses, and even find opportunities while others are reacting emotionally. Whether you're a beginner or experienced investor, knowing how to recognize market breakdown signals can help you avoid costly mistakes and make smarter financial decisions. Watch until the end to learn how to stay ahead of market crashes and protect your financial future. Is your portfolio bulletproof, or is it a ticking time bomb waiting for the next market meltdown? Most investors panic when the storm hits, but a select few see the warning signs long before the clouds even gather. Today, we're pulling back the curtain on the subtle yet powerful signals that tell us a significant market shift is on the horizon. This isn't about fear-mongering, it's about empowerment. We're going to arm you with specific indicators, the economic whispers, and the market tells that sophisticated investors and traders watch. By the end of this discussion, you'll have a clear roadmap to identify, understand, and navigate the volatile waters when the market truly breaks. Picture this. Wake up one morning. Stocks are plummeting. Headlines scream about recession. Your investment portfolio feels like it's melting away. For most people, this moment is pure panic. Sell everything, often at the absolute worst time, locking in massive losses. Why? Because they were caught off guard. They didn't see the storm brewing, or they ignored the subtle rumblings beneath the surface. This isn't just about losing money. It's about losing confidence, abandoning a long-term plan, letting emotions dictate financial decisions. The biggest challenge isn't the market breaking itself. It's our reaction to it when we're unprepared, letting fear override logic and strategy. So, how do we prepare? It starts by understanding the key indicators that flash red before the big drop. Think of them as the market's early warning system. First, we look at the economy's health. Is it vibrant or cyclical? Keep an eye on things like GDP growth. If it's slowing down or even contracting for a couple of quarters, that's a big red flag. Then there's inflation. If prices are rising too quickly, measured by things like the Consumer Price Index, CPI, or Producer Price Index, PPI, central banks, like the Federal Reserve, often step in and raise interest rates. Higher rates make borrowing more expensive for businesses and consumers, which slows down spending and investment, putting a drag on the economy. Don't forget unemployment rates. A steady climb in job losses indicates businesses are struggling, further dampening consumer confidence and spending. Lastly, manufacturing surveys, like the Purchasing Managers Index, PMI, tell us if factories are humming along or hitting the brakes. A PMI below 50 signals contraction, a bad sign. These fundamental economic pillars must be strong for the market to thrive. When they start to wobble, the entire structure will shake. This one sounds complicated, but it's a simple, powerful signal. Normally, if you lend money for a longer time, say for 10 years, you expect to get paid for interest in a shorter time, 2 years. But an inverted yield curve means the opposite. Short-term bonds pay more interest than long-term ones. Why does this matter? It signals that investors expect economic trouble in the future. They believe that interest rates will be even lower in the long run because a recession is coming, so they're willing to accept less for holding long-term bonds now. Historically, this has been an incredibly accurate predictor of recessions, preceding every U.S. recession since 1955, with only one false positive. When financial news starts talking about an inverted yield curve, pay very close attention. It's often the canary in the coal mine, singing a somber tune. Think of it like buying a house. If prices are ridiculously high compared to what people actually earn, a correction is likely. In the stock market, we look at price to earnings, PE ratios. This tells us how much investors are willing to pay for each dollar of a company's earnings. If average PE ratios are far above their historical averages, especially the Shiller-Cape ratio, which smooths out earnings over a decade, It suggests the market might be overly optimistic or overheated. When valuations get stretched, there's less room for error, and any bad news can trigger a steep fall. It's like a stretched rubber band. It can only take so much tension before snapping back. Imagine a dance floor. If only a few superstar dancers are putting on a show, but everyone else is sitting on the sidelines, it's not a strong party, is it? In the market, breadth refers to how many individual stocks are actually participating in an uptrend. If major indices like the S&P 500 are still going up, but fewer and fewer individual stocks are contributing to that rise, it's a warning sign. This divergence, where a few big names are propping up the market, indicates underlying weakness. Similarly, watch trading volume. If the market is going up on low volume but falling on high volume, it suggests conviction is on the downside. People are eager to sell when prices drop, but hesitant to buy when they rise. This is the CBOE Volatility Index, often called the Fear Index. It measures how much investors expect the S&P 500 to swing in the near future. A low VIX means calm waters. A high VIX means choppy seas ahead, signaling investor fear and uncertainty. Spikes in the VIX are often seen just before or during significant market downturns. It's like a storm barometer for the stock market. When this needle starts to jump, it's time to prepare for turbulent weather. When investors get nervous, they don't usually pull all their money out of the market. Instead, they shift it from riskier growth sectors, like technology or speculative small-cap stocks, into defensive sectors, like utilities, consumer staples, or healthcare. These are companies that tend to do okay even when the economy slows down because people always need electricity, food, and medicine. A noticeable shift, or sector rotation, out of speculative assets and into these safer havens is a clear sign that big money is bracing for a downturn. They're seeking shelter from the impending storm. This is perhaps the most insidious sign of all, when everyone, from your barber to your Uber driver, is giving you hot stock tips, and there's a widespread belief that this time is different, that the current bull run can never end. That's often a peak. It's human nature to get caught up in euphoria, to believe that gravity no longer applies. Historically, such widespread optimism, often fueled by easy money and speculative bubbles, precedes sharp corrections. Remember the dot-com bubble of the late 90s or the housing boom before 2008? When you hear echoes of "this time is different," be very, very skeptical. Now, here's the crucial part. No single indicator is a crystal ball. The market is a complex beast. What we're looking for is a confluence of these signals. When you see GDP growth slowing, inflation rising, the yield curve inverting, valuations stretched, market breadth deteriorating, VIX starting to tick up, coupled with a general feeling of irrational exuberance, that's when you know the odds are heavily stacked against continued smooth sailing. This isn't about predicting the exact day or hour of a crash. It's about understanding the environment. It's about being prepared, having a plan, and knowing that when these alarms sound, it's time to shift from offense to defense, or even look for opportunities to capitalize on the coming volatility. So, when the market shows signs of cracking, remember to look beyond the daily headlines. Pay attention to the economic bedrock, subtle warnings from bond markets, stretched valuations, the shifting tides of market sentiment, and the underlying strength of the rally. These indicators are your roadmap. They empower you to make informed decisions, protecting your capital and positioning yourself for future growth, rather than being swept away by panic. To truly master market psychology and navigate these shifts, watch this video next. Thanks for watching the video.